Welcome to Insight to Income, where powerful ideas become practical wisdom. We're diving deep today into a book that fundamentally shifts how we view one of the most critical and, let's be honest, often most stressful parts of our lives, money. And here's the core thesis we are unpacking. The author teaches us that financial success, it has shockingly little to do with intelligence or complex math or, market knowledge. It has everything to do with something much softer, yet far more difficult to master: your behavior and your personal psychology.
That's the entire game right there. Our mission in this deep dive is to really conduct a forensic examination into the psychological mechanics of wealth. We want to understand precisely why our emotions consistently, override logic in financial decisions, and how cultivating a long-term, humble, and emotionally stable mindset is really the only sustainable shortcut to building and keeping real wealth. This is not about optimizing a spreadsheet. It's about mastering the human being who holds the spreadsheet.
Okay, so let's jump right in. Part 1 is all about the foundations of our financial behavior. Chapter 1 kicks it off with a title that immediately grabs you: No One's Crazy. And this immediately challenges one of our biggest assumptions. The core concept is that financial decisions are intensely personal. What looks normal or, rational to you is entirely shaped by your unique life experiences.
Right, and the book emphasizes the sheer power of your background here. I mean, think about it. If you grew up during a period of intense financial volatility, say your family lived through the 2008 housing crisis, or maybe you saw hyperinflation, your tolerance for risk will be profoundly different. It's wired into you differently than someone who, say, inherited assets in a decades-long bull market.
And that's the key, isn't it? That difference in tolerance isn't a flaw. It's a feature of their history. The book points out that judging someone's decision like keeping huge amounts of cash instead of investing it is pointless unless you understand their story. Their choice, however, mathematically suboptimal it seems to you, is a product of a reality they actually lived.
Yeah. Exactly. It becomes a survival mechanism. The book gives the example of someone who grew up during the Great Depression. To them, the idea of leveraged debt, even for a safe asset, feels existentially terrifying. But to a young investor today, in 2024, debt might just seem like a tool, a normal part of the process. They're running on completely different operating systems. The author is basically asking us to admit that we're all playing this money game based on a sample size of our own life.
So humility is the big takeaway here. You have to be humble enough to recognize that your financial success might have been significantly helped just by being born at the right time in a stable country. And on the flip side, never assume someone else is stupid. Their internal logic, forged by their own unique struggle, is sound to them.
Yeah, it forces you to stop projecting your own risk tolerance onto everyone else.
That concept of inherited perspective, it leads us perfectly into Chapter 2, Luck and Risk. This is a topic that can be profoundly uncomfortable, I think, especially because it challenges that myth of pure meritocracy. The core idea is that success and failure are never purely about talent and hard work. They contain these invisible, powerful layers of luck and risk that we tend to ignore.
The book does a fantastic job defining these two as flip sides of the same coin. They are both outside of your control. And we love to study success stories, right? We look at the titans, the Steve Jobs, the Bill Gates, and we attribute 100% of their outcome to their brilliance. But the author reminds us to look at the invisible infrastructure of luck that was supporting them.
The famous example of Bill Gates is perfect here. I mean, beyond his undeniable genius and drive, he had a statistically improbable luck of attending one of the only high schools in the world in the late 1960s that had a sophisticated computer terminal. That's specific access at that specific time. That was just random chance.
It was. And if we acknowledge that powerful luck boosted his success, we have to acknowledge that equal and opposite risk can sink genius. For every successful outlier like Gates, there are thousands of what the author calls unlucky geniuses. These are highly talented people who, through no fault of their own, were taken out by a health crisis, or born in a place without access to capital, or they just got caught in an economic depression at the worst possible moment for their career.
So when we analyze an outcome, if we only look at the person's actions, their hard work, their decisions, we're ignoring the entire distribution of chance that either lifted them up or pulled them down. It means success isn't just about making the right moves. It's about being present and surviving long enough for those right moves to pay off when luck finally favors you.
And the practical lesson is really twofold. When you succeed, you have to maintain extreme humility because chance absolutely played a part. You have to avoid thinking you're invincible. And when you see others fail, offer compassion. Recognize that a smart decision can be completely obliterated by bad luck. Our job is to stack the odds in our favor through our behavior, but you can never expect a guarantee.
If you're enjoying these insights and ready to turn powerful ideas into practical wisdom, make sure you hit that subscribe button to Insight to Income. We turn big ideas into clear, usable lessons so you can act, not just listen. Okay, that brings us to Chapter 3, which cuts deep into the psychology of ambition. Never enough. The core concept here is that the greatest and maybe the most difficult financial skill is knowing when to stop chasing more. Because ambition without guardrails, it's a direct path to catastrophe, even after you've already won.
This is where greed transitions from a motivator into a destroyer. The book highlights these tragic stories of people who had amassed wealth far beyond anything they could ever spend. I mean, enough for several lifetimes of extreme comfort. And yet, they risked all of it for the short-term thrill of just a little more.
It's that difference, isn't it? The difference between being rich enough to satisfy your needs and being so ambitious, you risk your stability for gains you don't even need. The market doesn't care if you have 10 million or 10 billion. The rules of risk are the same for everybody. When you risk what you have and need for what you don't have and don't need, that's when the collapse becomes almost inevitable.
And this is so often driven by social comparison. The moment you enter that trap, always looking at someone with a bigger house or a faster jet, your goalposts just move further and further out. Enough becomes this endlessly receding target you can never hit. True wealth is an internal victory against your ego, not an external display for others.
So the single most actionable step from this chapter is to define your own personal enough. You have to draw a line in the sand where the marginal emotional gain of another $1 million is just not worth the risk of losing the security you've already built. It forces you to prioritize that long-term stability over the short-term dopamine hit of a thrill.
Absolutely.
So Chapter 4 deals with something that should be simple, compounding, but it's psychologically baffling. The chapter is called Confounding Compounding. The core idea is that compounding is the most powerful financial force, but it requires near superhuman patience, because the growth is just frustratingly slow at first.
The human mind really struggles with exponential math that plays out over decades. We get linear growth, right? Put in $100, get 10 back. Simple. But we fail to grasp that in compounding, the growth in, say, year 30 might be larger than the combined growth of the previous 20 years. The book stresses that time is fundamentally more important than your rate of return. Consistency over 50 years at 7% will almost always demolish aggressive, inconsistent returns at 15%.
And that initial waiting period is brutal. The first $100,000 feels like it takes forever. It requires so much discipline. But the last $100,000 in a huge portfolio might take 3 months and requires zero effort. This disparity, this front-loaded psychological burden, is why so many people give up before the magic really starts.
We see this so clearly in historical figures. The vast majority of Warren Buffett's immense wealth was accumulated after his 50th birthday. The initial decades were just the necessary time for the snowball to slowly, accumulate. It was the endurance, the consistency, and the sheer length of time that caused that exponential liftoff, not a single brilliant trade.
So the primary lesson here isn't to chase high returns. It's to protect the engine that generates the growth. If compounding is your ultimate asset, the key strategy is to avoid big, catastrophic losses that wipe out decades of accumulated time.
That's it. Losing 50% doesn't just mean you need 100% gain to get back to even. That's the simple math. The real loss is the decades of compounding you would have gained on that capital during the recovery period. So the best way to leverage compounding is just to keep the machine running consistently, forever.
Which brings us to Chapter 5. And this makes a crucial, life-altering distinction. Getting wealthy versus staying wealthy. These are two completely different skill sets. They require different mindsets, different levels of caution. Getting rich often involves taking measured risks, betting big on a venture, being aggressively optimistic. Staying rich is, well, it's almost the opposite.
It's the survival mindset that reigns supreme in that second phase. Getting wealthy requires an engine fueled by confidence and optimism. Staying wealthy requires one fueled by a deep-seated pessimism and a margin of safety. The true wealth formula isn't about achieving the highest possible return. It's what the author calls avoiding zero.
Right. We often confuse the skills of the accumulator with the skills of the preserver. Someone who is brilliant at launching a startup might be disastrous at managing a large, diversified portfolio. The temperament required for the first one, aggression, leverage, is actually toxic for the second one. which needs humility and caution.
The greatest success stories in wealth management aren't the people who had the highest average annual return. They're the ones who survived every major economic downturn without getting knocked out of the game. And that survival is protected by humility. Once you have enough, you need to be humble enough to admit that your good luck might run out and that the market will, inevitably, turn against you.
So the practical steps here are crystal clear. Staying wealthy means you drastically reduce unnecessary risks. It means having what the book calls survival capital money you never ever put in jeopardy, even if it means missing out on a few percentage points of theoretical return. Because the only prerequisite for long-term success is survival.
You have to stay in the game.
Exactly. So as we move into part 2, we're focusing more on the deeper psychology of wealth. And we hit chapter 6, Tails You Win. This is, I would argue, the biggest paradigm shift the book offers for how we think about investing. The core concept is that in financial outcomes, a tiny number of events, the tails of the distribution, drive the overwhelming majority of your success.
This is basically the finance equivalent of the 80-20 rule, but it's often way more extreme, like 955. If you analyze a diversified portfolio of, say, dozens of investments, the author shows that just 3 or 4 of them, the massive outliers, are likely responsible for 95% or more of your total returns. Everything else just kind of breaks even, loses a little, or goes sideways.
And this has a massive psychological implication. If a few winners are carrying the entire portfolio, it fundamentally changes how we should view our losses. We tend to obsess over the duds, right? The small losses, the inevitable failures. But the book says those small losses are just the price of admission. Missing just 1 or 2 of those huge opportunities hurts you far, far more than suffering a bunch of small failures.
That's the mindset shift right there. You have to accept that being wrong most of the time is not a failure. It is the natural mechanism by which you ensure you are present for the few times you are spectacularly right. If you invest in 20 things and 17 of them fail, you can still succeed massively if those other 3 winners are true outliers.
It means you shouldn't judge the health of your strategy based on daily ups and downs, or even quarterly reports. You have to focus on maximizing your chance of capturing those positive outliers by having broad exposure, staying invested, and just being patient. The key is surviving long enough for those few transformative winners to show up.
If you find this breakdown helpful, subscribing to Insight to Income helps you learn faster, think sharper, and build a stronger wealth mindset with every episode. Subscribers get instant access to insights that simplify complex books into practical wisdom. So hit that subscribe button and join our community.
Moving on to Chapter 7, Freedom. This gives us the ultimate non-negotiable definition of what money is actually for. The core concept is that the greatest, highest utility of wealth is not consumption or luxury. It is control over your time.
This is probably the book's most profound psychological takeaway. Money's greatest power is not buying bigger things, it's buying your independence. Being able to wake up and decide precisely what you want to do, who you want to do it with, and for how long. That is the ultimate dividend paid by financial success.
We often chase this cash-rich status, only to find ourselves trapped in a time-poor existence. You're working endlessly to maintain the cash flow that's required for this oversized lifestyle you've built. The author argues that being time-rich, having autonomy and flexibility, is superior to having massive income attached to golden handcuffs.
Financial independence grants you the invaluable ability to say no, just no. Yeah, you can refuse bad opportunities, you can leave toxic jobs, or you can simply spend more hours with your family. The whole purpose of building wealth isn't for ego or display. It's for constructing a moat of autonomy around your life. Your time is literally your real currency. And wealth is the tool that lets you redeem that currency on your own schedule.
And that pursuit of display. It leads us right into Chapter 8, the man in the car paradox. This concept brilliantly exposes a common psychological trap. When people see you driving a luxury car or wearing an expensive watch, they admire the object and the lifestyle it represents. But not you, the person who bought it.
This is the great financial self-deception we all fall for. The paradox is that the admiration you're seeking never actually lands on you. The person looking at your fancy car isn't thinking, wow, that person is successful and cool. They are thinking, wow, if I had that car, I would be successful and cool. They're just projecting their own desire onto the object itself. They're not assigning respect to the owner.
It's a guaranteed zero-sum game of ego. You buy expensive things specifically to gain respect and admiration, yet you immediately disappear behind the object. The feeling of prestige is fleeting, and the financial cost is permanent.
Right, and the book teaches us that true prestige, the kind that elevates your social and professional standing, is earned through your behavior, through kindness, humility, and the control you exhibit over your life. Flashy purchases often just scream for attention, signaling insecurity rather than genuine power. The key lesson is, stop buying things to impress people you don't even know, let alone like.
So true. Now, let's combine chapters 9 and 10. They form the fundamental, quiet core of true wealth building. Chapter 9 is Wealth is What You Don't See, and 10 is Save Money. The core concept is that real wealth is inherently invisible. It lives in savings and investments in reserves, not invisible material things. Rich is loud, wealthy is quiet.
That contrast is so vital. Rich is a current income statement. It's visible spending, fueled by a high salary or often by debt. Wealthy is a secured, quiet balance sheet. It's the reserves that provide flexibility and options for the future. The book shows that spending visibly proves nothing about your financial health. In fact, it's often proof of fragility or poor cash flow management.
The invisibility of wealth means that your personal satisfaction has to come from the knowledge of your security, not from the admiration of strangers. And this transitions directly into Chapter 10, which argues that the habit of saving is the most crucial element of all. Saving matters more than your income level or achieving high investment returns.
Consistency in saving trumps brilliance in investing, especially in those early decades. The act of saving is the foundation of freedom because it is entirely within your control. You cannot control market returns, you can't control inflation or your job security, but you can control the gap between what you earn and what you spend.
And the author emphasizes that wealth truly grows when you rigorously protect that gap and just ruthlessly limit lifestyle inflation. When your income rises, the temptation is to immediately raise your expenses. Fighting that urge, keeping your lifestyle steady, is how that quiet, invisible wealth begins to compound dramatically. Saving is your buffer against a chaotic world. Well said. Chapter 11 gives us a really practical rule for making financial decisions that align with our humanity. Reasonable is greater than rational. The core concept is that perfect economic logic rationality is often unsustainable for human beings. Sensible, stick-to-able behavior reasonableness wins in the long term.
The academically ideal strategy, the one that maximizes every single percentage point of return based on pure math, often fails because it ignores the psychological element. We're emotional creatures. A highly leveraged, aggressively managed portfolio might be rational on paper. But if the stress of it causes you to panic sell during a 30% downturn, well, it was a terrible, unsustainable decision for you.
The author uses a powerful example: paying off a low-interest mortgage. Rationally, you should probably invest that money elsewhere for a higher return. But for so many people, the psychological security of owning their home free and clear and the reduced monthly stress, that is worth more than the marginal percentage gain they might get in the market. That feeling of security is reasonable.
Consistency beats short-term perfection every single time in the decades-long game of wealth accumulation. The focus has to be on finding a system you can emotionally handle and stick with, even if that means leaving a few percentage points on the table. If a decision helps you sleep better at night, it is financially sound for you.
Finally, in this section, we address the unavoidable reality of the world in Chapter 12, surprise. Okay. The core concept here is that the future is inherently unpredictable. And most truly massive market-moving events, the ones that reset the economy, come as complete, fundamental surprises.
We waste so much mental energy trying to forecast the next specific recession or the next political shock. But the author reminds us that the most significant events, pandemics, unforeseen wars, major financial crises, were, by definition, outside of the model. History doesn't repeat itself. Only human behavior, broadly speaking, exhibits patterns.
It's a certainty trap to believe you know exactly where the economy will be next year. If those predictions were easy, the market would already have priced them in, and there would be no opportunity left. The fact that the future generates staggering surprises is exactly why we need that margin of safety we discussed earlier.
So the practical takeaway is to stop spending time predicting the specifics. Instead, focus on preparing for the broad patterns. We know recessions happen, we know inflation occurs, we know businesses fail. Build flexibility, resilience, and liquid reserves. Your defense against the unknown is not prediction. It is robust preparation for uncertainty.
Okay, that takes us into part 3, which is all about durable strategy and mindset. We start with Chapter 13, Room for Error. Given the constant surprise of the world, a margin of safety is the single most important tool for long-term survival.
And the concept of a margin of safety is broader than just having extra cash. It's an approach to life where you never run too close to the financial or emotional edge. It means always having buffers, a few extra months of liquid savings, lower leverage in your investments, and, more time than you think you need to complete a major project. Small buffers prevent large, irreversible disasters.
Yeah, what's truly counterintuitive here is the idea that safety actually makes you brave. If you're operating with maximum efficiency, zero leverage, no savings cushion, every small surprise becomes a crisis that forces you to make terrible, panic decisions, like selling low.
But if you maintain significant reserves, you gain the emotional strength to endure volatility. When the market drops 30%, you aren't forced to sell your stocks to pay an unexpected bill. You can just hold your breath, knowing you can survive bad luck or market turbulence. Room for error is the difference between a setback and a knockout.
Hit that subscribe button to Insight to Income so you never miss our weekly deep dives into books that build your money mindset. If you want that consistent flow of practical wisdom, that's exactly what subscribing guarantees you, helping you simplify complex books into clear, usable knowledge every week. All right, Chapter 14 reminds us that our primary financial opponent is often our future self. The chapter, You'll Change, argues that your future goals and desires will inevitably be different from your current ones. So you have to plan with maximum flexibility. Always leave your options open.
We all suffer from what psychologists call the end of history illusion. We believe that the person we are today is the final, evolved version of ourselves. The book highlights that the things you value today, a certain career path, a specific city you live in, may feel suffocatingly wrong to the person you are 10 or 15 years from now.
And the danger lies in making these massive, permanent, rigid financial decisions based on temporary feelings. Maybe you think a huge 30-year mortgage on a massive house is the peak of success today, but your future self might desperately want the freedom to travel or change careers without that massive debt hanging over them.
The strategy, therefore, has to be radical adaptability. Accept the evolution of your goals as a given. Review your long-term plans regularly. And more importantly, avoid massive, illiquid, high-commitment structures that prevent future you from pivoting. Liquid assets and lower fixed costs are basically insurance against future regret.
That leads to Chapter 15, which tackles the hidden cost of investing. Nothing's free. The core concept is simple. Everything worthwhile in life, and especially in investing, has a price. And in investing, that price is volatility, uncertainty, and fear.
Volatility is not a fine you pay for doing something wrong. It is the necessary tuition fee you have to pay to earn the long-term rewards of compounding. If market returns were guaranteed, instant, and risk-free, everyone would be rich instantly, and those high returns would they'd cease to exist. They exist because most people cannot stomach the emotional cost.
So when the market inevitably drops 20% in a month, which it will multiple times over your investing career, that isn't a failure of the system. That is simply the quarterly tuition bill arriving. You must be willing to pay that emotional and psychological price to earn the long-term reward.
If you panic and you withdraw your money during the downturn, you have effectively paid the tuition fee, but you've dropped out of the course. You lose the long-term payoff. So the action required here is powerful. Accept volatility as normal, necessary, and the inherent cost of admission. You have to be prepared to endure the pain in order to gain the reward.
Chapter 16 emphasizes the unique individual nature of all this. It's titled, You and Me. Because money success is fundamentally tied to your personal psychology and your timeline, you absolutely cannot copy someone else's strategy and expect it to work for you.
This is the most crucial counterbalance to all the finance advice you see on social media. Every single person is running a different race. A 25-year-old with zero savings but 40 years of time ahead has a completely different risk profile than a 55-year-old nearing retirement. And what works for a professional hedge fund manager operating with institutional capital, well, that will be disastrous for an individual investor.
The book stresses that when you look at a successful investor, you see the surface-level outcome, but you don't see their balance sheet, their tolerance for debt, their family history, or their actual goals. They might have a massive inheritance, or they might be highly leveraged and on the brink of total failure. You just don't know.
So the mandate is absolute individuality. You have to create your own unique financial plan that is aligned with your personal timeline, your income stability, your psychological tolerance for risk, and your personal definition of enough. You have to avoid the comparison trap entirely. Their goals are not yours, and their financial DNA is not yours.
Chapter 17 highlights a deep psychological bias, the seduction of pessimism. The core concept is that negativity, catastrophe, and doom. They always sound smarter, more serious, and more sophisticated than sensible, long-term optimism.
This is a function of media and human attention. People trust pessimism because bad things happen quickly, catastrophically, and they're highly visible. A market crash takes days and dominates the front page. By contrast, good things like GDP growth, technological improvement, compounding happen slowly, quietly, and continuously in the background over decades.
The person warning of imminent collapse, claiming the system is broken and offering some complicated fear-based trading strategy, they sound like an intellectual expert. The person who says, just keep buying diversified assets slowly and patiently for 40 years, sounds boring and unsophisticated.
To succeed long-term, you have to actively fight this bias. You need what the book calls constructive optimism, which requires you to zoom out beyond the 24-hour news cycle to see the decades of progress and human ingenuity that ultimately tend to overcome the periodic crises. You have to maintain faith that progress is usually stronger than panic, even though panic is always louder.
And we wrap up our chapter-by-chapter dive with Chapter 18, When You'll Believe Anything. This final psychological concept argues that when we're faced with uncertainty, people gravitate toward convenient, comforting stories, even when they aren't entirely true, because those stories reduce our anxiety.
Narratives are so potent. Emotions consistently overpower complex analysis. When we're uncertain about why the market tanked, we prefer a simple story, say, the CEO of Company X is corrupt, over grappling with complex macroeconomic factors. It's just easier and more comforting to have a simple villain.
This tendency leads directly to market bubbles and irrational behavior. If a stock or an asset has a great, compelling story, even if the fundamentals are weak, people are willing to overlook the flaws, because the story gives them comfort, a sense of shared excitement, and a belief that the path to wealth will be quick and painless.
The warning is clear. Question the easy stories. Avoid making major investment decisions based on market hype, convenient tales, or overly simplified narratives that promise a shortcut. We need to seek the difficult, often uncomfortable truth of complexity over the comforting fiction of easy wealth.
Wow. That was a comprehensive journey through the core behavioral lessons of the book. Let's try to synthesize these powerful ideas. The overriding theme is that money success is overwhelmingly about behavior, about resilience, and personal psychology. It's not about academic smarts or complex calculations.
To recap the wealth formula, it requires patience to allow for compounding, and it demands that you recognize the powerful dual role of luck and risk. You have to actively focus on building and protecting your hidden wealth, your quiet savings and investments, over the visible, consumable lifestyle you project to the world.
And ultimately, the final non-negotiable goal of wealth is freedom. Specifically, control over your time. The path to achieve this is consistency. You have to adopt a financial strategy that is not mathematically rational, but reasonable and sustainable for you. The person who has to live with it through decades of market surprises. Reasonable consistency always beats rational perfection.
And if you are wondering what your next financial move should be, just remember this. The most important decision you make isn't what stock you buy or what rate of return you seek. It's your own definition of enough. Once you define that limit with humility and clarity, everything else falls into place, protected by your margin of safety.
That is a perfect and deeply provocative closing thought. Thank you so much for joining this deep dive into the psychology of money. If you want to continue turning complex books into clear, usable knowledge and build that consistent wealth mindset, subscribe to Insight to Income for more deep dives every week.